Good evening, students. Am I audible? Let's confirm, then we will start.
Yes, sir.
Thank you. So, in this subject, that is financial reporting, actually, we finished the first three chapter in last few sessions. Okay, near about 10, 11 sessions. We finished the first three chapter. That is, first chapter is the financial statement preparation framework. Next one is the preparation of corporate financial statements. Okay, so in first session, so actually we see what are the base for, to in the preparation of the financial statements. Okay, we understand the different purposes for which we prepare the financial statements. We understand the scope of the financial statements. We understand what are the different type of assumptions or principle we used while the preparation of the financial statements. Okay, we also understands some of the qualities of the financial statement. That is, we can say the understandability, neutrality, prudence, completeness, realistics. So all these are the some of the main features of the financial statements. In second chapter, we actually see the we can say the preparation of the corporate financial structure. Okay, in division 2 of companies amendment act 2025, we see the four different types of financial statements that is each and every organization is prepared at the end of the financial year. Okay, so how to prepare the balance sheets, how to prepare the profit and loss account, how to prepare the cash flow statements, and how to prepare the statements in the uh, changes in equity. So all these four statements which are compulsory, and what is the basic format for all these we can say the financial statements. Okay, we see all the we can say what the different guidelines given by the division 2 of schedule 3 of the companies amendment act. Okay, that we see in the second chapter. In third chapter, actually we see the presentation of different types of items in the financial statements. Okay, and the revenue recognitions. Okay, so we see the Indian accounting standard 1, that is the presentation of the financial statements. So what are the basic guidelines for this purpose? Okay, so the guidelines for the statement of cash flows, that is AS7. We also see the AS8, that is the whenever we know that the accountant do any mistakes, that is the errors, we can say, if they do any errors in the estimations, or whenever the policy changes, accounting policy changes, so at that point of time we use the Indian AS8. Okay, so in Indian accounting standard 34, we see the interim financial reporting. We learn that some of the prestigious companies, okay, which want to disclose their financial informations in between the financial year. That means they want to establish their financial information quarterly or 6 monthly to their different stakeholders. Okay, to we can say to build the confidence of the different stakeholders in the company. Okay, so this is how we understand all these AS and Indian accounting standard 115. We understand the revenue from the contract with the customers. How we make the entry of the revenues. What are the different types of revenues? Okay, so all these part we see in the chapter third. So okay, so now today we start the chapter number 4, that is the reporting of assets, liabilities, and disclosures in financial statement using the relevant accounting standards. Okay, so how we make the entries of the assets and liabilities and their disclosures in the financial statements. So all that part we are going to cover in this chapter, that is chapter number 4. So in this chapter, we are going to understand the different Indian accounting standard related to the assets and liabilities, and how what are the different rules and regulation to disclose uh, the assets and liabilities information in the financial statements. Okay, so what is we can say AS2? So AS2 is that is Indian accounting standard is tells all about the inventories, how to make the entries of the inventories in the Indian accounting. We can say in the financial statements. So okay, so all these guidelines which we follow, which is given in the Indian accounting standard 2. In Indian accounting standard 2, we actually we mastering the accounting treatment for one most critical component of the working capital management in the business, that is we can say the inventories. We know that there are the different types of inventory actually we handle in the companies. That is the one type of inventory, that is the raw material. Okay, so whatever the companies required for the production purpose. Okay, so whatever the goods the company is producing, or whatever the service the companies we can say is providing to their customer to produce that goods or to produce that service, the company needs some type of raw material. Okay, so that raw material is also we consider as a inventory is we can say it is a type of assets which we are going to sell after some period of time. Okay, how we are going to sell? We convert, if it is a raw material, then we convert into the finished goods. If it is the work in progress inventory, then we can say we convert fully into the finished goods. And if it is the we can say it is the finished goods inventory, then we stored that inventory in the godowns for some period of time, and whenever the customer demand, then we supply the same finished goods to the customers. So these are some types of the inventories, that is the raw material, work in progress, and the finished goods inventory. Okay, so how we make the entries of these different types of inventory in the different types of in different types of financial statements. That is how we make the entries of inventories in the balance sheets. We know that the inventory is actually the, we can say it is the current assets. Okay, that means we convert that inventory into the cash within the 365 days. We know that the inventory we put into always into the current asset sides. Okay, so what are the different rules, or what are the different types of inventory we include into the financial statement as per the rule of Indian accounting standard 2, and what are the different types of inventory which exclude as per the Indian accounting standard 2. Okay, so that that we can say it's mandatory to know to any accountant or the financial experts. Okay, so which are the different types of inventory we not included as per the Indian accounting standard 2. Okay, if you don't know, we can say we misplace the value of the inventory from the another Indian accounting standard to as per the Indian AS2. So what are the exclusion? What different types of inventory we exclude from this India's AS2? So all this part we are going to understand uh, in these sessions. Okay, so what is Indian accounting standard 2? That is the first questions. So what is the core purpose of the Indian accounting standard 2? We can say the prescribed comprehensive accounting treatment for the inventories across all the businesses. Okay, how for the different businesses the accountant made the entries of the inventory in the financial statement for all the businesses. So that is the core purpose. And what is the primary focus of the Indian accounting standard 2? It establishes the clear guidelines for the cost determination and the systematic recognition as an expense. We know that to purchase the raw material, to purchase the inventory, we as a company has to expend some amount of money, okay, to purchase the inventory. We can say the company has some expenditures. Okay, so the first type of expense is the cost of raw material itself. We can say the then the carrying cost. Okay, we know we need the company needs the, we can say, the transportation cost, and the another cost is the, we can say, the holding cost, that means the storage cost. Okay, so these are some types of cost that we need to include into the inventories. Okay, so what is the critical component of the Indian Accounting Standard 2? That mandates the write downs to net realizable value when the market condition deteriorate. So the net realizable value is, we can we can say, the combination of all these values. That is the value of raw material, then the transportation cost, then the holding cost. So when we sum uh, made the summation of all these values, then we get the net realizable value. Okay, so the Indian Accounting Standard 2 serve as the, we can say, the cornerstone standard for the inventory accounting in India, ensuring the, we can say, the consistency and transparency in financial reporting across all the industries. It is aligned with the international best practices while addressing the specific requirement of the Indian business environment. Okay, so in these sessions we are going to understand how we made the uh, entries of the inventory in the financial statements actually. Now, what is the scope and what are the things we exclude from the Indian Accounting Standard 2? Okay, where we apply the Indian Accounting Standard 2, first we can say the Indian Accounting Standard 2 applies comprehensively to all the inventories across the business entities, ensuring the uniform treatment and the comparability in the financial statements. That means we apply the Indian Accounting Standard 2 for all type of entities, for all type of businesses, for all type of inventories, exclude the followings. Okay, the key exclusion is given to us in the following three lines, that we such, if the such a type of inventory comes to us, then we not make the entry in the financial statements as per Indian Accounting Standard 2. Okay, we exclude such a type of inventory. So which are the those inventory which we exclude from the Indian Accounting Standard 2? So let's see which are those things. So the financial instrument governed by the Indian Accounting Standard 32 and 109. Okay, so in as per the Indian Accounting Standards Standard 32, if the company is holding some of the financial instrument like the stocks, shares. Okay, so all these entries we make as per the Indian Accounting Standard 32 and 109. So if this such a type of inventory is held by the companies, we do not make entries of those inventory as per the Indian AS, but we make the entries in the financial statement as per AS 32 and AS 109. Uh, Next exclusion is, we can say, some of the biological assets. Okay, related to agriculture activities under AS 41. So we know that some of the companies which are working in agricultural sector, okay, if they're having some biological assets, so we cannot consider that biological assets, biological inventory as a ordinary inventory. Okay, so to make entries of such assessed, we already have the, we can say, the separate Indian accounting standard. So we make the entries of the biological inventory, biological assets as per the Indian AS 41. Next one is the work in progress under the constructions contract. We know that constructions contract means we can say the huge building constructions. So okay, so in a such a type of we can say manufacturing. Okay, so work in progress under the construction contract, we do not consider that inventory as per the Indian Accounting Standard 2. Okay, so all these are the exclusion from the Indian accounting standard 2. Okay, thank you, Rohit sir. Sorry, guys, there is a electricity shortage at my place, so my Wi-Fi is disconnected. Okay, so we'll start. Actually, we see the Indian Accounting Standard 2. Okay, so Indian Accounting Standard 2 is all about the, we can say the inventory disclosures. Okay, so we see that some of the exclusions we are understanding, that is some of, we can say, if the biological or the agricultural inventory is there. Okay, so then we exclude uh, as per the Indian Accounting Standard 2, and we made the entry as per the Indian Accounting Standard 41. Okay, if the we can see if the inventory is related to constructions contract, then we exclude such a type of the work in progress under the construction contract. Then such a type of inventory also we exclude. If some of the financial instruments like the shares, stocks, we can say some treasury bills. So these are we also exclude as per the Indian Accounting Standard 2, and we actually we make the entries as per the Indian Accounting Standard 32 and 109. Okay, so what we called as the inventories. Actually, first we need to understand before making the entries into the financial statements, what is the inventories. What we called as inventories first, that is the assets held for sale in the ordinary course of business. That is means the assets which we are going to sell into some time of period in futures. That assets we called as the inventory currently in the production process or existing as a material and supplies to the consume in the production or service. Okay, if the inventory is raw material, then we convert it into the finished goods. If it is a work in progress, we made the final product. And if the final product is available, okay, then we will sell that product to the customers. Okay, so this is what we called as the assets held for sale. That assets we called as the inventory. Okay, so we can say what is the net realizable value. If you can say calculate the estimates selling price in the ordinary course of business less the estimated cost of the completion and the estimated cost necessary to make the sales. Okay, that means all the cost we required to the cost necessary to make the sales, that means to produce that product and to the final sale of the product, all these value we called it as a, we can say, the net realizable value. Okay, so that is what we called as the inventories. Okay, so how we calculate the cost of the inventory. Okay, what are the different components of the cost? Okay, so the what are the different components of the cost of the inventory? So the inventory cost encompasses the purchase price, that is the price of that inventory. Then the we can see the conversion cost, all other costs incurred to bring the inventories to the present location, and the condition, that is we can say the price of that inventory. Then we can say the transportation cost, holding cost, then the cost we require to convert that raw material into the finished product. Okay, and then we sell that finished product to the customers. Okay, so all these costs we called. So these are the different components of the cost. That is first one is the, you can say, the purchase cost, the cost at which we purchase that inventory, that raw material. That is the including the import duties, that is the transfer cost, handling cost, and we can say the storage cost. Okay, all these cost we call we considered as the purchase cost. So next cost is, we can say, the conversion cost. Okay, when we get the raw material now, we need to convert that raw material into the finished product. So that type of cost we call as the conversion cost. So we can say the direct labor, direct material, we can say the factory cost, electricity cost. So all these cost we conversion cost that need to convert the raw material into the finished product. That cost we called calculate as the conversion cost. Okay, so these are the costs we consider for the inventories. Okay, so what are the different disclosure requirement as per the Indian Accounting Standard 2? Okay, so first requirement is the accounting policies. Okay, we need to disclose the informations of the inventories as per the Indian Accounting Standard 2. First one is the accounting policies, that is the detailed description of the inventory accounting policies, including the cost formulas used and the basis of the NRV, that is the net realizable value determinations. Okay, so we need make the entries as per the accounting policies. Okay, we need to we can say calculate the whole value of the inventory. That is the, we can say, the we consider while entering the value of the raw material, or we can say the inventory, we have to do the summation of all these things. Okay, so as per this and we need to enter the all the detailed description of the inventories. Okay, so first the disclosure is the accounting policies. Next one is the carrying amount. Okay, so total carrying amount of the inventory is broken down by the appropriate classification such as raw material, work in progress, and the finished goods. Okay, so what are the cost we required for the transportation, for the carrying of the different types of inventories, that is the raw material, work in progress, and the finished goods. So all these amount we clearly or the separately mention. Next one is the expense recognition, that is the amount of inventories recognized as expense during the period, typically the cost of goods sold. We know that the cost of goods sold, we minus from the revenue, then we got the gross profit. Okay, so how we calculate the cost of goods sold? We the summation of sum of the expense, that is the summation, that is the cost of raw material, then we can say the carrying cost, holding cost. Okay, then the, we can say, the direct labor, factory cost, electricities. Okay, so all the summation of all these costs we require to convert the raw material into the finished product. That cost we called as the cost of goods sold. Okay, so we make the entries for that, the cost of goods sold. Okay, and the down write down and the reversal, that is the amount of any write down and the reversal of the write down recognized during the period with the explanatory circumstances. Okay, so whenever we, if we have a, we can say we purchase the inventory. Okay, but we can say we give back some inventory because of some damages. Okay, or because of some, we can say we don't want that inventory in that amount at that time. Okay, so all these entry or the adjustment must be clearly mentioned while entering the inventories into the financial statements. Okay, so all these are, we can say, if you see the what is the inventory life cycle. Okay, how the inventory, we can say, you guys already know the product life cycle. Might you learn that in the operations and I think operations and supply chain management. That is first you purchase the raw material, then you hold that raw material, then we put that raw material on the machineries. That is in a work in progress. Then that work in progress converted into the finished product. Then you hold the finished product for some point of time. When then you sell the finished product, then you get the cash. Okay, by using that cash, you buy the raw material. Again you put that raw material on the machinery, that is work in progress. Again you do the finished product. So this is the product life cycle. So same likewise, we have a, we can say, a inventory life cycle. That is the, this comprehensive, this inventory life cycle is nothing but a comprehensive flow chart. We can say that illustrate the complete inventory journey, how inventory, we can say, flows in the company. That is the inventory life cycle, highlighting the critical decision points for the cost accumulation, net realizable value testings, and the financial statements impact. So this is the, we can say, the inventory life cycle. Okay, first we can say make the demand for the inventories for the raw material. That is what we call as the procurement of the raw material. Okay, then we store that raw material for some period of time. Okay, then we do we send that store raw material on a machineries, that is the work in progress. Then we convert that into the finished product. Okay, then we can say we pick that finished product and pack that finished product, and then we shipped those large trucks, and then we buy to the customers. Okay, through the some of the distributors. Okay, so this is how the inventory, we can say, flow in the company. That is the inventory life cycle. Okay, so this is all about the Indian Accounting Standard 2. Okay, so I'm going to share you the details of here you can read thoroughly the Indian Accounting Standard 2. Okay, just a second. Rohit sir, I joined from the another account. Please make me the co-host so I can share the some information from my laptop. Rohit sir, please make my another account as a co-host. Can I do this from my account? Just a second. Rohit sir, can you make me the co-host? Yes, thank you, Rohit sir.
Yes, sir.
So,
Done, sir.
yes, yes, thank you, sir. I'll share with you the Indian Accounting Standard 2. Okay, so you can read here if you see on your screen. Okay, so this is we are actually we reading this on the Indian Accounting Standard, that is the CA 2013.com. This is the one website on which you can read the whole guidelines which is given in the. Okay, so these are the guidelines which is given in the Indian Accounting Standard 2. Okay, so if you write the objective of Indian Accounting Standard 2, the objectives of the standard is to prescribe the accounting treatment for inventories. The primary issue in accounting for inventories is the account amount of cost to be recognized as an asset and carried towards until the related revenue are recognized. That means why we need the inventories? Uh, we need the inventories to produce the finished product. Okay, that means we incurred the cost on the inventories to recognize the revenue, and when the company recognize the revenue after selling the finished product. Okay, so this standard deals with the determination of cost and is subsequent recognition as an expense, including any write down to net realistic value. It also provides the guidelines on the cost formula that are used assign cost to the inventories. Okay, we actually see all these, that is the cost of goods sold, net realizable value, how we need to calculate. So all this part we already know, that you guys that learned in the subject, we can say in the managerial accounting. Okay, so this standard, okay, so this standard does not apply to the measurement of the inventory held by. Already we see the exclusion in the PPT. Here you can write the same exclusion, that is the producer of agriculture and the forest product, agricultural produce after harvest, mineral product, to the extent that they measured at an measurable value in accordance with the well established practices in those industries. When such inventories are measured at the net realizable value. Okay, so all these are the guidelines, that is for the we can say for the inventories, how we include the inventories into the financial statements. So if you read the definition, point number 6, the following terms are used in the standards with the meaning specified. So inventories are assets. Okay, so here is the definition of inventories given. If you get read that inventory are assets held for sale in the ordinary course of business or. Okay, so this is the first definition, that inventory are the assets held for the sale. Next definition is inventories are the assets in the process of production for such a sale. That is mean the work in progress. Also we consider as a inventory. Okay, so those product who are, we can say, actually making on the machineries which is currently in a process, that's what we call as the work in progress. So all these we called it as the inventory. Okay, so inventory are the assets in the form of material or supplies to be consumed in the production process or in the tendering of the services. So all form of materials or the supplies which are we used while the production of the product or the production of the services. So all these we considered as the inventory. Okay, so here we read the definitions on how here if you read the measurement of inventory, how we measure the values of the inventories. Okay, so for this purpose here the guidelines is given, that is the nine inventories shall be measured. Here is point number 9, that is inventories shall be measured at the lower or cost of the net realizable value. Okay, the cost of purchase, cost of conversion. We already see that part in the PPT. Okay, but here in the Indian Accounting Standard 2 guidelines, we can say the detailed descriptions or detailed guidelines are given here. Okay, so this is actually we can say this 5 to 6 uh, pages. Okay, so you can write this things, okay, whenever you guys have a time. Okay, so I'll share the link for this Indian Accounting Standard 2 with you guys in a chat box. Okay, so you whenever you have time, please read this, so you will have the we can say the great understanding. Okay, so this is all about the Indian Accounting Standard. Okay, so in next accounting standard, that is that we are going to understand, that is tells us about how we make the entries of the just a second, I'll share with you. So in the, can say in the next AS is next AS is you can say the Indian Accounting Standard 16. It gives us the guidelines on the, we can say, the property, plant and equipments. Okay, so for this assets, how the companies has to make the entries in the financial statements. So for this purpose, here in this accounting standard 16, the guidelines given to the organizations, to the companies. That is the, we can say, the exploring Indian accounting standard 16. Okay, so how we are going to explore. Okay, what is given in the Indian accounting standard 16. Okay, what which on which things this accounting standard provides us the guidelines. So the guidelines is based on the, we can say, the property, plant, that is the properties companies having. Okay, if the company is having the different types of property, how the companies has to enter these things into the financial statements. Next, about the plants. Okay, plants means the, we can say, the manufacturing plants to manufacture any goods, to manufacture a service. So so we know that for this purpose the companies have needs we can say the big plants. Okay, so next one is the equipment, or we can say the machineries, different type of machineries and equipment the company is having. How for this purpose for this property, plant and equipment, how company needs to make entries into the different financial statements. Okay, so here we can say first we understand what is the scope of the Indian AS 16. Okay, what things we are going to exclude from the AS 16. Okay, and what are the what is the main objective of the AS 16. So in scope, if you guys read, that is the Indian AS16 is applies to the tangible assets used in a production. That means so those tangible assets means we know that the company is having always the two types of assets. First one is the we can say the tangible assets, and next one is the intangible assets. So the tangible assets are those assets which we can touch and feel. Okay, for example, we can say the plant, machineries. Okay, so all these things, or we can say the property, office, computers, we can see the printers. Okay, so different types of machine. Okay, assembly lines. So all these, or we can say the big data centers. So all these are the we can say the tangible assets any company having, any company possess. So next one is we can say the intangible assets. So intangible assets are those assets which we cannot touch and feel. For example, we can say the goodwill of the organizations, or the we can say the number of number of we can say the different patents this company is having. So all this goodwill, or we can say the different types of patents. So all these are the intangible assets. So here in Indian Accounting Standard 16, we are only talking about the tangible asset. That means in the Indian Accounting Standard 16 is only responsible for the making the entries of the different tangible assets which is possessed by the companies. So this Indian Accounting Standard 16 applies to the tangible assets used in a production, supplies of the goods and services, rental to others, or the administrative purposes with the useful life existing 1 year. Okay, so all these assets the company is using for more than 1 year, that is the plant, machineries, equipment, or we can say the administrative offices, or the we can say all these tangible assets we use for the supply of goods and services. Okay, so, for example, the big trucks. Okay, so all these part we consider as the we can say the uh, tangible assets. Okay, so the key exclusion. So all these such a type of we can say the assets. Okay, and all these assets we called as the non-current assets. That means these assets we cannot convert it easily into the cash. That requires the time period of more than 1 year. Okay, so what are the exclusions? What we are not going to include in the AS16, that is the assets held for a sale. Okay, so that means if the company is, if for example, if we say if the Mahindra is the products producer of the we can say the tractors or the trucks. Okay, they are we can say the producing the big trucks, big assets. Okay, but they are producing that things for the sale purpose. So we cannot consider, or we cannot enter such a type of assets as per the Indian Accounting Standard 16. But we make the entries for such a big assets which the company is producing for the sale purpose as per the Indian Accounting Standard 105. Okay, we can see the biological assets except the bearer plant. Okay, so all type of biological assets that we not included as per the Indian Accounting Standard 16, or we can say the mineral rights, or we can say the exploration assets. Okay, if you find any minerals, or we can say the oil, silver, gold. Okay, so we cannot make entries of all these assets as per the Indian AS16, but for this purpose, there is we can say the different AS. The investment property, if the companies make the in any property for the investment purpose, then we cannot make the entries for such a property as per the Indian 16. But actually, we make the entries for such a property as per the Indian AS 14. So, what is the primary objective of the AS 16? To prescribe the comprehensive accounting treatment for the property, plant, equipment, machineries. Okay, so enabling users to understand the entity's investment in these assets, and it changes in the such a type of we can say the plant machineries equipment. Okay, so this Indian accounting standard 16 ensures we can say the consistent treatment of the significant capital investment, providing the transparency about the assets utilization, that is the utilization of the equipments, utilization of the different machineries which implant by the companies for the productions of the goods or services. Okay, or we can say in this we know that this plant machinery and equipments is depreciate. That means their values depreciate as per the time. Okay, so how that depreciation pattern. Okay, so for all this purpose we are making the entries as per the Indian accounting standard 16. Okay, so recognition of the PP. So for to to whom we called as it is the property, plant, or equipment. Okay, so we can say the when we can say the for to recognize the PPE, that is the plant, property, and the equipment, that is the economic benefit test. Okay, if these two tests fulfilled by the such a type of assets, then we included that in the Indian accounting standard 16. That is the future economic benefits associated with the assets are expected to flow to the entity and demonstrating the clear value generalization potential over the asset's useful life. Okay, we that means all such a type of assets that we use for the production purpose. Okay, to generate the revenue. Okay, that means the future economic benefits. Okay, when we get the future economic benefits, when we made the product by using the machinery in the plant. Okay, in the property of the company, then the company is having the future economic benefits associated with the assets. That means the plant, equipment, are the assets which gives the future benefits. So all such a type of property or the long-term assets we included as per the Indian Accounting Standard 16. We can say next criteria is the reliable measurement. That is the cost of those assets can be measured. We can say the reliably, ensuring the accurate financial statement presentation. And okay, so for all such a type of assets, that is the plant, property, and equipment, we know that we can calculate its value in an exact number in a rupees. And so we can say if the value is we find it is measurable, then we included that entry into as per the Indian Accounting Standard 16 into the financial statements. Okay. So next one is what are the different components of the PPE? Okay, we know what we include in the plant, property, and the equipment that we are going to understand, that is the purchase price. We know that to purchase this such a type of investment, the huge investment is required, huge amount of money is required. So first one is we can say the purchase price. Next one is we can say the direct the purchase price, including we can say the purchase price, import duty, non-refundable purchase taxes. So all this part. Next one is we can see the directly attributable cost, that is the site preparation, delivery, installation. We know that to when we purchase the property land, okay, to install the plant, okay, so the huge time we can say the infrastructure it required. Okay, so all this part we included into the directly attributable cost. Next one is the dismantling cost, that is the initial estimates of the cost for the dismantling, removing, and the restoring the sites when the obligations exist. Okay, if the reconstruction is required for any such a type of property on the plant. Okay, so all these components are considered as the PPE, that is the we can say the property, plant, and equipment. Okay, so to measure after the measurement after the recognition, that means there are the two types. By using these two methods, we can calculate the value of the property, plant, and the equipment by using the two methods, that is the cost methods and the revaluation method. Okay, so cost method is the initial cost that the company is paying for that plant, equipment, or that property. That is the cost method. And the revaluation method means we know that the value of the such a type of long term asset, that is the value of the plant, the value of a property, and the value of equipment is continuously changing. Okay, so in revaluation method, we can say we uh, revaluate the current price of the such a type of property, plant, and equipment, and then we make the entry in the financial statements. Okay, so this is all about. So what is the disclosure requirement under the Indian Accounting Standard 16? Okay, so first one is, we can say, the whether the cost model or revaluation model is used for each class of property, plant, and equipment. Okay, so first we need to fix which type of model we are using to calculate the cost of the such a type of assets, that is the plant, machinery, equipment. And by using that model, that is the cost model or a revaluation model, we calculate the cost and then we make the entry in the financial statements. Next one is, we can see the depreciation details. We know that all the such a type of assets, that is the plant, equipment, and the machineries, that depreciates over a period of time. Okay, so we know that we have the two depreciation method. That is, we can say the first one is the straight line method, and next one is the compounding depreciation. Uh, okay, so by using any of the depreciation method, we minus the depreciation value from the actual cost or the revaluable cost of these machineries. Okay, so these are the additional disclosure requirement is the details of revaluation, including the dates, methods, and the fair value determination, impairment losses, and the reversal recognized during the period. Okay, the restriction on the titles. So all these, we can say, the restrictions required in the as per the Indian Accounting Standard 16. Okay, so we know that what is the PPP life cycle. Okay, the life cycle of this plant, property, and the equipment. First we acquire that property. Okay, then it's depreciate its value, then we revalue, okay, revalue that plant, the revalue the actual real value or the today's values of this property, plant, and equipment. Okay, then we expose these things, then we implement, then again we revalue it. So this is the PPE life cycle. Okay, so here are some of the key. So why this Indian Accounting Standard 16 is important? If I show you the exact document which what is written in the Indian Accounting Standard 16, if you see on your screen here, the Indian accounting, so all these guidelines is given here. Okay, so I'll share the link with you. Okay, so please read all these guidelines. Okay, carry this link with you and read the whole guidelines. Okay, so when we read the objective of the Indian Accounting Standard 16, the objective of the standard is to prescribe the accounting treatment for property, plant, and equipment. That is for the all type of non-current assets. So that the users of these financial statements can be discuss information about an entity's investment in its property, plant, and equipment. Okay, and the changes in such a type of investments. Okay, so that means when we revalue this such a type of assets, then there is a change in the investment. Or we can say when the company is extra, when he extra purchase the equipment, or he expand the plant, in that such a type of case, it is, we can say, the changes in the investment or the principal issues in the accounting for property, plant, and equipment are the recognize of the assets determinations. Okay, so all these are the guidelines given in the Indian Accounting Standard 16. If we read the scope, that is, this standard shall be applied in accounting for property, plant, and equipment, except when the another standard requires permits the different accounting treatment. Okay, so this standard does not apply to. We see all these exclusion. That is, we can say we see the biological or the some of the agricultural assets. Okay, or some the minerals or the mineral reserve, we cannot write as per the Indian Accounting Standard 16. Okay, so if you read, so this is actually the 6 to 7 pages guidelines which is given in the Indian Accounting Standard 16, that how we made the entries of plant, property, and equipment in the financial statements. Okay, if up to that, if you have any query, you can ask. Okay, if here is given one point, that is measurement of cost, how we calculate the cost for the property, plant, and equipment. The cost of items of the property, plant, and equipment is the cash price equivalent at the recognized date. Okay, so at what price the companies purchase that assets, that is nothing but the, we can say, the that is the direct cost method. And one more item, that is we revaluate as per the current market price. Okay, so this is how we measure the cost. Okay, so here is given cost model, here is given how we calculate the depreciation. Okay, so this is all guidelines given in the Indian Accounting Standard 16. Okay, so here we finished the Indian Accounting Standard 2, that is gives the guidelines for the inventories, how we make the entries of the inventories in the financial statements, and Indian Accounting Standard 16, that is for the property, plant, and equipment. For the such a type of non-current assets, how we make the entries, what are the exclusions, what are the different types of methods to calculate the cost of the such a type of assets. Okay, so this is all about. So here we finished. You can leave the session now and join the other sessions. Thank you. Thank you, students. The time is up for the session. Please leave the session and join the another session. Thank you. Rohit sir, please end the session.